Hello everyone. ESG investing is not as simple as one could think. For example, how to integrate that ESG bond funds are not holding any ESG-labelled fund, or that a multi-century-old fund manager has decided to exclude assets linked to the Chinese government, or also that the deterioration of governance in Turkey makes the country less compatible with responsible investment. Opinions differ and underline the fragmentation of the market. And in addition, in some countries, the regulator has imposed standards that raise new questions. In Europe, the taxonomy requires that investment funds categorize themselves according to the ESG criteria they apply. A study by ABN AMRO reveals that only 7% of the trillion assets held by bond funds declare under Article 8, the least restrictive one, are invested in ESG-labelled bonds. Some funds do not even hold any. Does this mean that funds are declaring themselves ESG without being ESG? While this is the case for some, it's not the case for all. Some industry players are focusing on their own analysis of companies' business models rather than relying on labels, and the exercise is also extended to governments. The Dutch fund manager Van Lanschot Kempen excludes state-owned Chinese assets from its investments. The inclusion of governance data such as press freedom or the level of corruption in its analysis has tipped the balance. However, the market has an appetite for non-state-owned Chinese funds with an environmental focus, as asset under management more than doubled in the last 12 months. The market is now worth $47 billion, ahead of the 31 in the US, but still well behind the 325 billion in Europe. China's commitment to carbon neutrality has paid off, and investors have been attracted and rewarded. Chinese funds have gained 15% over the last 12 months, while their American counterparts have lost 7.2%. And make no mistake about it, ESG is a factor, but so is performance. The market's reception of products that exclude Chinese government bonds, even though the financial benefits are there, will be interesting to follow. While many investors will remain active in this market, the answer is less clear for Turkish bonds. Despite its posture as a mediator between Russia and Ukraine, Turkey continues to go down a worrying governance path, to the point that the apparently profitable risk premium offered by Turkey, in view of its low debt levels, raises questions. It may not be sufficient to compensate for the risk increase. While the addition of ESG criteria could have led one to believe that the decision-making process would be simplified, good ones, bad ones, it increases the complexity of the analysis. If there is one thing, however, that remains stable regardless of the number of factors, it is that the ESG investor is still an investor. He just has more questions to ask himself. Thank you.